Taxes are visible and recurring, so they feel personal. For most people, the biggest chunk of income tax is withheld automatically, and the pain of a big bill makes the mind search for escape routes. Imagine almost half of your yearly income being spent on tax. You barely have any left to enjoy your life. Of course, you would want a different path to take. And historically, those routes were found not by criminals alone, but by careful experts who read the law and reorganize their finances to take advantage of what the law permits. The phrase, "never pay taxes," is dramatic. In practice, the simple truth is this: you can often reduce, defer, or shift tax obligations so much that your effective tax burden becomes negligible. Doing so requires time, capital, professional advice, and critically strict compliance with local and international reporting rules. The Cayman Islands, the British Virgin Islands, and Switzerland all have one thing in common that billionaires just love: financial systems that prioritize privacy and tax efficiency. In short, offshore banking systems. Welcome to Luxo-Life, and today we will be fully enlightened on the legal way to never pay taxes and how billionaires get away from paying theirs. A quick reminder: there is no one quick magic way to permanently avoid taxes without ever touching the law. This video is fully informative and inspirational and not legal advice. Consult a licensed tax attorney or accountant before you act. Let us start with offshore banking. Offshore banking simply means putting your money in a country where the financial rules are more favorable for you. These countries, often called offshore financial centers, are designed to attract global wealth by offering advantages that traditional banks in high-tax countries cannot compete with. Offshore banks usually operate under systems with low or even zero taxes, meaning income and profits can legally grow without being eroded by heavy taxation. They also have privacy laws that protect account holders to an extraordinary degree. In some places, your name does not even appear in public financial records. The banks themselves are often bound by strict confidentiality agreements, ensuring that your financial information is not easily accessible. Offshore jurisdictions tend to have looser reporting standards, giving you autonomy over your money. You are not required to explain every inflow and outflow of cash the way you would in a highly regulated system like the United States. Of course, not everyone can walk into these systems. Offshore banking is typically open to those with significant capital, the type of clients that nations actively compete to attract. These financial havens roll out the red carpet for the wealthy because their money strengthens local economies and supports the global financial web. Offshore banking, when done correctly, is not illegal. It is not about hiding money under the table. It is about strategically placing it where it is treated best and where the law, sometimes by design, rewards you for doing so. Traditional vs. offshore banking. To see the difference, imagine the two worlds side by side. In traditional banking, your income is tightly monitored. Before money even reaches your account, it is reported, taxed, and tracked. In the United States, for example, anyone who holds foreign bank accounts totaling more than $10,000 is required to report them. There is no room to maneuver. Everything you earn is visible to tax authorities. Now, imagine an alternative world. A person living in the United States earns their income not as a direct salary, but through a web of offshore entities. Say this person developed a company, but instead of owning it personally, the rights belong to a holding company based in the Cayman Islands. That holding company, in turn, is owned by a trust established in another country, perhaps Switzerland or the British Virgin Islands. When the company earns money, those profits do not flow directly to the person, they flow to the offshore entity. When this person finally receives money, it is not labeled as salary, which would be subject to high tax rates. It comes as dividends, royalties, or trust distributions, forms of income that are often taxed much less, or even exempt, depending on where the money travels. This is the essence of tax avoidance, not tax evasion. Tax evasion is when you break the law by refusing to pay taxes you legally owe. Tax avoidance is the legal art of reducing what you owe by understanding the system and using the rules as they are written. If you report a company dinner as a business expense, you are already engaging in tax avoidance. Offshore banking simply takes this idea to a more complex international level. It is still within the bounds of the law, just optimized for those who can afford the game. The Apple case, the billion-dollar blueprint, perhaps the most famous story of modern tax avoidance, involves Apple. In the early 2000s, Apple set up subsidiaries in Ireland that could technically sell Apple products. These subsidiaries allowed the company to funnel global profits into low-tax entities, avoiding most standard corporate tax rates almost entirely. From 2003 to 2013, Apple reportedly earned over $120 billion through this arrangement. Their effective tax rate during that time? A shocking 0.005%, meaning for every $1 in profit, Apple paid roughly 50 cents in taxes. To put that in perspective, if those same profits had been taxed in the United States, Apple would have owed around $40 billion. Instead, it paid about $600 million in Ireland. So how did that work? Apple established two companies in Ireland that were not conventional businesses. They did not build iPhones or employ massive teams. Their sole purpose was to legally collect profits from Apple's international sales. When a customer in Japan bought an iPhone, the profit didn't go to Apple's US headquarters, it went to the Irish entity. Here's where Apple found a gap in the system. The Irish subsidiaries were incorporated in Ireland, but they were managed from the US. Under Irish law, this meant they weren't subject to Irish taxes. But under US law, taxes were based on where a company was incorporated, and since these companies were registered in Ireland, they weren't taxed in the US either. In essence, the profits floated in a kind of tax limbo, legally untaxed anywhere. The setup was so effective that it drew the attention of the European Union. After years of investigation, Apple was ordered to pay $14 billion in back taxes, not because it had broken the law, but because regulators decided it had stretched the rules too far. The Apple case became a masterclass in how companies use legal structures to minimize taxes, and also a warning about the fine line between clever strategy and overreach. How it all works. To understand how individuals replicate what corporations do, imagine creating a company that exists only on paper. You register a shell company in a place like the Cayman Islands, the British Virgin Islands, or another offshore paradise. This company does not need to have an office, employees, or even a physical presence. On paper, however, it is real and recognized under the law, and that is what matters. Next, you let this company own your money and assets. Instead of buying a mansion in your name, the company purchases it. Instead of opening a Swiss bank account under your identity, it is opened under the company's name. Technically, you do not own anything. Not the house, not the cars, not the art collection. The company owns it all. So if someone comes after your assets, there is nothing for them to claim. You are protected by a legal veil. To make the structure even stronger, add a trust on top of it. The trust, often based in a different country, owns the offshore company. You are not listed as the owner of the trust, you're merely the beneficiary. The trust holds the company, and the company holds your assets. From a legal standpoint, your name disappears from the ownership chain, even though the wealth still benefits you. This layered setup trust over company, over assets, is not fiction. It's a standard practice among the global elite, from CEOs to royal families. And when managed properly, it follows every letter of the law. Why this system works? The effectiveness of offshore structures relies on one concept: jurisdiction. Every country has its own rules for what it taxes and how. Some countries tax based on citizenship, like the US, others based on residency, and some not at all. When wealth passes through multiple jurisdictions, each with its own definition of taxable income, gaps appear. Wealthy individuals use these gaps to their advantage. By earning money in a country that does not tax foreign income, then transferring it through a trust or shell company in another low-tax jurisdiction, they can drastically reduce or delay taxes. In many cases, the tax owed in their home country is minimized through credits, treaties, or deferred reporting. It is complex, yes, but it's completely legal when done transparently. Offshore banks and trust companies even market these services openly, promoting international wealth management or tax-efficient estate planning. They're not hiding. They're operating within the global financial framework that governments themselves created. Conclusion? Still, the world has changed. Decades ago, offshore banking was nearly invisible, but in the modern era of transparency, countries have cracked down. International cooperation agreements, like the Common Reporting Standard, CRS, now require banks to share information with tax authorities worldwide. Secrecy is not what it used to be. The phrase, "never pay taxes," is misleading. What the rich truly master is timing. They delay taxes, sometimes indefinitely. By holding assets through companies and trusts, they can defer tax events for decades. They reinvest earnings instead of taking income, allowing their wealth to compound untaxed. They do not cheat the system, they design their lives around it. Every purchase, every structure, every account exists with intent. While the average person receives a paycheck and loses almost half to taxes before touching it, the wealthy earn, hold, and distribute wealth through entities that let them keep nearly all of it. We hope this video gave you important information for you to start your search for financial freedom smartly and not ignorantly. If it helped you, don't forget to subscribe to Luxo-Life for more. Until next time.